Welcome to the Advisory Group's Economic and Market Update to start the third quarter of 2023. Thank you for attending this webinar. Let's first start with some introductions. My name is Manny Jinche, and I'm a wealth advisor with the Advisory Group. Also joining me is Brent Beverly, the president of the Advisory Group. Both of us are certified financial planner practitioners. At our firm, we partner with clients, and we believe that an educated client is our best client. So while we will always try our best to help you when it comes to your finances, we believe that knowledge is power. And one of our missions is to share with you any knowledge that can better help you make an informed decision. As we like to say, the more you know about what is going on, the more you will appreciate what we do. Today's agenda is straightforward. First, we will share a brief investor update on the first half of 2023, and then we'll discuss some ideas and strategies for you to consider. We find that it's always important to review that there are 5 key areas of financial planning. They are preservation planning, retirement planning, estate planning, and tonight we will focus primarily on tax planning and investment planning. So even though today's presentation is primarily about equity markets, as a comprehensive wealth management firm, we try to always consider the impact of any recommendation we make on not just one, but all of these areas for our clients. Now, to lead us off on our market discussion, allow me to bring up Mr. Beverly. Brent?
Well, thank you, Manny. Now, seasoned investors understand that equities are long-term investments and market declines are just part of the investment experience, the same way, say, traffic jams are part of the driving experience. 2022 was one of the worst years for equity investors. Now, an interesting fact surrounding the big loss year in the stock market is sometimes they're followed by big losses, but many times they're followed by big gains. So let's just look at every double-digit down year for the S&P 500 going all the way back to 1928, along with the ensuing returns for the following year. So historically, after a bad year, you're either looking at feast or famine. You either experience a huge rally or further losses. So it's not a foregone conclusion what stocks are going to do this year. But at least through the end of June, the S&P 500 is up more than 15%. The first half of 2023 has continued to remind us that markets don't move in a straight line and volatility is simply part of the investing experience. Despite everything, however, the equity markets remained resilient in the first half of the year despite continued interest rate increases, banking closures, debt ceiling adjustments, and just overall volatility. So for the first half of the year, 2023 has taken investors on a bumpy ride. We called for volatility and we've gotten it. Now, we started the year with a slight uptick in year-over-year inflation rates. So worrying investors that the Fed would continue to raise rates at an exponentially fast rate. Then we were surprised by the banking crisis, shutdown of U.S. banks, for example, Silicon Valley Bank, Signature Bank, First Republic, and then in Europe, Credit Suisse. Interest rates were increased by the Fed 3 times, but by a lower percentage rate than we saw in 2022 when inflation was at its peak. Now, however, in June, the Fed paused the rate increases. And finally in May, Congress finally settled on a debt ceiling agreement, ending a lot of anxiety and potential problems. It is no secret that U.S. interest rates have risen faster than any other time in recent history. This is due primarily to control that runaway inflation rate. Raising interest rates is the Fed's primary defense in trying to adjust inflation, and they've been very aggressive in the past year, raising rates by almost 5 percentage points in only 14 months. Now, this easily surpasses the second highest rate of 3.96%, which happened between June of 2004 and June of 2006. But that time, the Federal Reserve used 24 months to get a lower rate increase. Now, another big rise was back in March of 1988 to May of 1989, when the Fed rapidly raised interest rates in that 14-month period by 3.25%, 3.23% if you want to be precise. So far, we have seen 3 federal funds rate range increases in 2023. The latest was on May 3rd, which brought the benchmark Fed funds target rate to a range of 5 to 5.25%. Now, this marked the 10th consecutive rate increase over the past year or so, which is the fastest pace of tightening we've seen since the 1980s. At their June meeting, though, the Fed decided not to raise interest rate, to take a pause. And as we said, Federal Reserve officials left interest rates unchanged in their June session. At that session, however, policymakers said that they might need to raise rates 2 more times this year as inflation, while it's moderating, remains very stubborn. Federal officials said in their policy statement that they were giving themselves time to assess how the economy was reacting to what the rapid campaign they've done to slow demand and wrestle inflation under control. Now, as this chart shows, the central bank had already raised rates to a range of 5 to 5.25% in a little bit more than a year. At the June session, policymakers predicted in their economic forecasts that they might raise interest rates even further to 5.6% by the end of 2023. Now, this would amount to those 2 more quarter-point rate increases that we talked about there in just a minute. Okay, quarter-point interest rate increases over the course of the Fed's 4 remaining meetings this year. Now, these projections sent a clear signal that the Federal Reserve officials are still worried about inflation's staying power and will need to do more to cool growth and bring price increases under control if inflation stays a problem. If we look at the key economic indicators that the Fed uses to assess what direction to move interest rates, the economy is still strong. Unemployment rates are low, job growth is healthy, and labor costs slowly continue to grow. The Consumer Price Index, a statistic used to measure U.S. inflation, has slowed considerably. Back in 2022, the CPI reached over 9%, whereas by the 1st of July 2023, it's all the way down to 4%. Now remember, the Fed's target is 2%, so we're not quite there yet. As I'm sure you're aware, borrowing costs have taken a hit with rising interest rates. If you're trying to buy a home, get an auto loan, if you have credit cards or interest-bearing debt, borrowing has become more costly. Now, according to Bankrate's chief financial analyst, Greg McBride, credit card rates are above 20%, home equity loan rates have doubled, and any recent mortgage or auto debt income, it comes at a higher price, guys. Now, if you're anxious about how continued inflation and interest rates might affect your unique situation, contact us. We're happy to address those concerns and help you walk through the scenario for yourself. Now, bond yields have had an interesting first half of 2023. Now, in 2022, most treasuries yielded at near record lows. However, now an investor can get some interest from bond yields. The first half of 2023 saw the few bank failures going on, which drove investors to treasuries in very large numbers for safety. As of June 16th, treasury rates seem to have stabilized, though. And as of June 16th, let's just look at some of these rates here. 5-year treasury notes yielded 3.99%. 10-year notes were at 3.77, 20-year notes at 4.05, and 30-year notes at 3.86. So kind of a sweet spot there for 20-year notes. Now, we'll continue to monitor how the Fed's movements and rising interest rates are affecting bond yields and try and incorporate those bonds as needed in your portfolios or other ways of using them. Now, as we mentioned, on June 1st, the Senate passed a debt ceiling measure suspending the nation's debt ceiling and putting caps on federal spending until January of 2025. Now that's very convenient for politicians because that's after the next presidential election. Funny how that works. Now the U.S. was on the verge of a major default, and this bill has helped stave off any potential catastrophe crisis by raising the amount of money the government can borrow. Some key changes in that bill were a reduction in the direct spending on domestic programs. Now, this does not include Social Security or Medicare. A reduction in IRS funding. Kind of a different one thing here. In 2022, as part of the Inflation Reduction Action, Congress had approved $80 billion for the expansion of the IRS. Now, this new bill pared that number back to reallocate the funds into other areas. There was a small increase in spending, a maximum of 1% in 2024 and 25. Now, this is primarily to cover military and veteran affairs. Now, student debt payments will resume once again later this year, according to this bill. That ends a 3-year freeze on student loan payments. Now, President Biden is still looking for ways around this. That's still a very active issue in case you're in that position. There was a clawback of unused COVID-19 funding. So what that means is if you didn't spend the money, they're taking it back. And then finally, there was an expansion of some large energy and infrastructure projects to help the economy continue to grow. So what does all this mean for investors? Don't you love this chart? Equity investors have remained positive overall. Historically, on average, the U.S. stock market has risen in the months following an agreement to raise the debt ceiling. However, this is not a signal to become complacent. With political pressures and continued change in monetary and fiscal policy, more volatility, uncertainty, just stay calm, okay? Don't expect, okay, everything's fixed now. Having a long-term focused plan in a well-diversified portfolio can help position you manage this kind of volatility. Look how volatile these things are. Now, we suggest you review your investments and make sure they're still congruent with your time horizon, risk tolerance, and goals. Now, to carry us on to the next level of our presentation, let me bring up Mr. Chinche. Manny, you take over here.
Now, we're pretty sure the volatility isn't likely to go away in the coming months, so investors really need to be prepared. Remember, if you have a well-diversified long-term financial plan, abandoning ship is probably not in your best interest. And as you can see from this chart, even with all those downturns, long-term investors who have stayed in the market over 10, 20, 30, or even 40 years were rewarded with considerable gains. Now, as of May, money market assets are the highest they have been in decades. If these funds started to go into the stock markets, this could have a decided effect on stock prices. This makes guessing about market moves even more difficult. So while there's a high amount of cash on the sidelines currently, that could change and affect equity pricing. This is another reason we feel that investors should not try to outguess any situations. There's still talk in financial circles about the possibility that the U.S. will experience a recession in 2023. Obviously, no one can tell for sure if this will happen, and even if so, at what level of severity. As a reminder, like downturns, recessions are not new concepts. The S&P 500 has weathered 17 recessions in the last century and never failed to recoup its losses. And please keep in mind that the S&P 500 historically starts to rebound before the end of a recession, which makes market timing a very poor investment strategy. Remaining financially liquid is very important during a recession. This means that you should make sure you can meet your financial obligations. And also, please consider, do you anticipate needing cash for a large obligation, such as the funding of a wedding or the purchase of an RV? We also want to touch base on the now finalized Secure 2.0 Act. On December 20th of 2019, a major piece of legislation known as the Secure Act was signed into law. In 2023, this bill was updated, and that legislation is now finalized. This new act brings changes for those of us with retirement savings. Now, we had a webinar back on June 21st where we covered portions of this act that we feel impact our clients the most. And if you missed the live webinar, there is a recording, as there are of all of our webinars, on the tagfinancial.com website. Now, reviewing the 2023 federal tax brackets that the IRS released, there on your screen, note that the tax brackets remain the same. However, the incomes for each higher bracket starts have increased in accordance with inflation. Here is a more conventional way of seeing the new tax bracket income levels. We have updated this in our materials, so if you need a copy, please reach out to us and we can get you that copy. These are available on our website. Look for our tag key numbers and tax triangle, which are located under tag tools on our website. The bottom line is it looks like volatility will be here for a while. And that is why we always abide by our mantra of proceed with caution. Staying the course and maintaining the consistency of a well-devised plan has historically served investors well. Having a proactive approach to your financial goals and a solid investment strategy is part of the holistic offerings we provide our clients. Again, investing is a long-term activity. And as a reminder, we are here for you to discuss any concerns that you may have. So while we cannot control financial markets, inflation, interest rates, we keep a watchful eye on them. These are challenging times for investors, and we want you to be comfortable knowing that we are staying apprised of any situations that may affect you. Our goal as the stewards of your wealth is to help you through uncertain times, just like these. We always attempt to help you create a well-crafted plan customized for your unique situation and goals that take into consideration how you will react to market ups and market downs, including your time horizon, tax implications, liquidity needs, risk tolerance, and your overall personal objectives. Although today we're discussing the economy and equity markets, later this year we will once again be proactively exploring and sharing some year-end tax planning strategies. And also as a special treat, we will have a webinar coming up regarding legacy planning. This is important for every adult and every family, so be sure to mark your calendars for Wednesday, September 20th at the usual 6 p.m. And we want to remind everyone, investing in equity should be viewed as a long-term commitment. We do not have predictive powers. Our crystal ball just does not work, but we understand that equity investors should look to meet their goals over long periods of time. Historically, investors with a long-term plan that stayed the course and remained invested were rewarded. Now, the coming months could be filled with uncertainty and more market volatility. So a few tips to help you through uncertain times are keep your head down and your eyes away from the media. Media magnification can cause anxiety and even cause investors to make emotionally charged decisions, which typically are not in their best interest. Also, pay down your debt and try not to incur any more debt during a higher interest rate environment. Put that off. Continue to add to your savings and investments. And finally, conduct a full review of your financial plan with us. Now, to take us to the conclusion of our presentation, allow me to bring back up Mr. Beverly. Brent?
All right. Thank you again, Manny. That was very good. That's tough subjects to cover. Now, as with all financial planning, we recommend that you focus on the long term. In our opinion, the most important concept of investing continues to be stay calm and keep a long-term perspective. And the advisory group is here to help you stay calm and keep that long-term perspective. I love quoting this gentleman, Warren Buffett. I want to leave you with a quote from him. It's someone sitting in the shade today because someone planted a tree a long time ago. And that's kind of the way the investments work. You got to plant the tree and then keep it watered, and eventually you get shade and comfort. Thought that quote was rather clever. Please pause your viewing here to review this slide for proper disclosures. I'm not going to spend too much time here because I know you can pause it. If you have any questions, please reach out to us. Here's our contact information. Let us know what you need. If you need anything, we're happy to help. That concludes our presentation. Please have a wonderful, safe, and healthy 2023. Best wishes to you.